Hey everybody, welcome to another free edition of our trader user group of Weekly Roundup. This is for the trading week ending Sept 20, 2019. I'm Preston Brent. I hope you're all enjoying, again, the final lazy days of summer. As a reminder, this coming Monday will be the official first day of fall. This past week's theme is there a plumber in the house? More on that in a minute. This past week, we saw the Dow finish down about a little over 1%, S&P about 0.5%, NASDAQ about 0.75%, the Russell down over a full 1%. We saw volatility climb up 11%. I think the VIX closed this week at 1532. In the world markets, it was a little bit mixed. We had the FTSE was down about 31 basis points. That's about 1/3%. The CAC 40 was actually up about 62 basis points. The DAX was absolutely flat for the week. And the Nikkei was up about 41 basis points. Although over in the Asian markets, China was down about 82 basis points. In Hong Kong, the Hang Seng was down a whopping 3.35%. And for the week, we saw the outperformance of utilities again. They were up about 1.71%, a little bit of a risk-off move this week, while the worst performer, or one of the worst, was the materials sector. It was down about 91 basis points. And looking at the PE ratios, the 12-month trailing PE is down just a little bit from last week. It's at 23.26. And the forward PE ratio, it's lower a little bit, but it was, I think it finished the week at about 18.25. So the forward PE is lower than the trailing PE, the 12-month trailing PE, by about 25% or so. I see the annual dividend yield in the S&P is still at 1.91%, and the 10-year interest rates at about 1.75. So anytime we get the annual dividend yield in the S&P greater than the 10-year interest rate, it does tend to push money into the markets. Okay, so it kind of provides a little bit of a lift to us, as I said. But this past trading week was cruelly, we had some conflict during the week. I mean, it started off with last weekend when we had the Saudi oil refineries were attacked. Moved oil up about 15% in the first part of the week, although it pulled back about half the gain a little bit, but it did still close up. One of the better weeks we've seen in oil for a while. We saw the Feds cut rates by 25 basis points this week. And in addition, the U.S. money repo markets, they were crazy. They went crazy, and I guess they caused the Feds to intervene. And at the end of the day, a delay to visiting the pig farmers caused the markets to give way to the end of the week, finishing slightly lower. The China delegation decided not to visit the pig farmers. They called it off after hearing Trump in one of his daily press briefers tell the press that he's looking for a full deal instead of a partial deal. So even though we still have water pressure in the pipes for the markets, we're starting to see some leaks. Market price action was kind of indecisive, and I guess rightfully so, though, right? I mean, if you were to listen to the TV pundits or the talking heads or the analysts, you're going to get a mix of news that, you have a bifurcation, some leaning one way and some leaning the other. I mean, the trade war with China may be cooling off unless, again, it starts to heat up. And then you got the economy heading into a recession, unless, of course, it's getting better. And then you got the Feds needing to cut the rates more aggressively, unless it shouldn't be cutting rates at all. And then finally, it's time for value stocks to shine, unless traders want to go back into growth stocks. So you can see the conflict and indecision in a lot of these talking points that I'm watching and hearing on TV and just reading in the biz press. So guys, as I say over and over again, for our members and for those of you that have been following me, we're all about price action and where it wants to go. Price action and volume, and just looking at what we want to see here. It's not what we feel, but what we see. All right. And that has kept us in good stead for all these years in our user group and our members happy. Of course, a lot of this confusion is with the Feds and their policy statement. If you look at our very own Jerome Boom Boom Power Ranger Powell in his press conference, I do give him kudos. He did a little bit better this time than the previous time. He's had a track record in previous press briefers of 82% of the time moving the markets lower. So this time he started off, price action went down, but he said a couple of the right things. Price action fought back and it recouped the day's losses to finish slightly in the green. But the bigger issue among the Fed right now is the split among the voting members on the direction of future rate hikes or not. Half the members, roughly about 8 out of 17, think the policy band, that's the interest rate band that where it should actually be lower by another 25 basis points before the end of this year. Hence, there's about a 60% chance of another rate cut factored into the pricing action by December. Remember, we have another Fed policy meeting the end of October. There will not be one in November, and then December is the last part of the year. So there's about a 65% chance of another 25 basis point rate cut, according to the market bond action in the 30-day Fed fund futures. But then we still have another half, roughly 7 of the board members, they think prices that rates should go higher. So there's kind of an even split, even among the Fed members, and where rates should go. So that's why we're starting to get leaks in the pipes. All right. And that's why I called for a plumber in the house earlier in this opening diatribe, because the markets are just, I don't like the price action. As I told our members yesterday early on in the day, I don't like where price action is sitting. And the way we close the week tells me that, we could still see some more downside here before markets kind of settle in. And finally, to cap off this week, I think, a lot of people are starting to hear about the repo market. We've been talking about it in our group for a while. But in the repo market, we had interest rates shoot up at some point over 10% until the Fed stepped in. Now, typically the interest rates in the overnight lending market is right around the trading band of the 30-day Fed fund futures, and that's where it should be, because the Fed's kind of control that. But left to its own market devices, there's a lack of liquidity over the past week, and it causes the rates to shoot up, or it did this past week. So the Feds had to step in. In fact, for the past 3 days, the Feds have pumped about $205 billion in liquidity into the overnight lending rates to get it back to more normalized levels. Now, historically, guys, this has indicated trouble, and that was, we kind of had this big liquidity crisis before the final collapse of Lehman Brothers, back before we really started the financial debacle in 08 and 09. But this time it's just a little bit different. There are some technical things standing in the way. But either way, it still is going to encourage the Feds to add to the U.S. balance sheet by injecting more funds, right? And I think we're going to see that, and that'll kind of ease that burden a little bit and take that worry off the table. But the markets are still really focused on the China-U.S. trade deal. And it seems like the algos are firing off every day on each headline news. But if you look at what I've got on the charts right here, you can see I've got the 30-day. I've got the E-mini S&P 500 futures on a daily chart. And you can see this in action right here. We have not gone anywhere. I had thought, and I had told our members, the only way we're going to get above 30.2950, which is the all-time highs in the futures market for the S&P 500, was that the markets react favorably to the Feds. They did not. The market sold off and then came up, as I said, and just barely broke even for the day. But then the past couple of days, Thursday and Friday, you can see the markets just didn't react kindly at all. In fact, we've been in this tight range. You can see that closing range band right there until we came into Friday, and then we closed down at the bottom of the range that we've been in all week. This past Friday with that sell-off, when the word came out that the Chinese aren't going to go see the farmers, the pig farmers, and other ag farmers in the Midwest. So the markets were highly sensitive to that. Now, I wanted to see if we would, that would be just an initial algo fire off and people sell, and then we make our way back. But we did not regain those highs. We closed near the lows for the day. That's not a good sign. Now, as I told our members, we've got a fair value sitting right at that level right there, just slightly below the 2940 area. I've got this zone shaded, which is kind of where we hung up for a long period of time. We could not escape that. We finally got escape velocity in early September. And now we've moved up, and some people said this is just a consolidation phase. And again, the only way that I'm going to go back into more of a bullish rant is if we can take out on good volume these all-time highs. Okay, otherwise we're going to be subject to come down and test this prior breakout point. We almost did after the breakout of about 3 days, but we didn't quite make it. So this is kind of what I'm watching. We've still got an upward cant in our 50 EMA and our 200 EMA. So again, we are still in a bullish frame of mind and a buy the dip, but we're in a dip moment. So I'm not ready to stick my toe in the water just yet. You can see we've got a value area sitting up here as well, just slightly above price action, and it's serving as tremendous resistance for the market price action right now. So we've got to watch it very closely. For our members, we'll break down some stocks and some key asset classes that I think are going to do fairly well in this indecision market as we go into the the 10th year, I guess, of this secular bull market. And we're getting ready to come into the 11th year coming up pretty soon. So this we want to follow really closely. If we look at the Dow futures, same thing, okay? We've got a cross in the MACD. You can see there's no divergences, so that still suggests a buy the dip moment. We've got a value area in the Dow sitting right around 26,800, roughly, just slightly south of where the Dow is right now. But we've got a nice spread in all the EMAs. So I would expect a little bit of a dip going into the week this next week. Remember, we've got earnings that are going to start kicking off in the next couple of weeks. We do have some earnings coming out. We did see FedEx, and they just blew their earnings big time. They sold off. So is that going to be a harbinger of things to come? I don't know. But if it is, we do have the PE ratios, as I said, are a little bit lofty, but keep in mind they can be lofty with very low interest rates. It tends to inflate PE multiples because there's no place else for money to go to get yield. So it kind of funnels its way into the stock market. And we see some of these rotational shifts from value to growth. And then within value, certain value areas, or in growth, certain growth areas. Like in growth, we may see software companies outperform technology companies, or FANG, and some of those other things. Because some of the FANG stocks are really taking it in the shorts right now. Microsoft seems to be the only holdup. For our members this Sunday, we'll go through a little bit more details, some of what I think could be some potential winners here over the Q4 period. But this is the Dow, okay? And then, of course, if we look at NASDAQ, which is one of the worst performers for the day on Friday, you can see here, again, same thing. We're above the 50 EMA. We're above the 200 EMA. The 50 EMA is starting to settle in flat. We got a little bit more of a divergence in the NASDAQ than we do in the others. So that would indicate that we could come down to the value area down here of around 68.90 roughly, or 76.90, or around 7,700. I want to see if we can hold the 50 EMA. That's going to be very important. Finally, the one that has played catch up a little bit and was the best performer on Friday, even though it finished down as well, is the Russell. Okay, so we're starting to see some of these cyclical companies, do a little bit better, and we're seeing some money rotate into them. You can see the Russell. We're above the 200, we're above the 50, but note that the 50 is still below the 200 EMA. That is still a bearish tone, okay? And I want to see that this big move here is going to be met by additional move higher. Perhaps maybe a little bit of a pullback, but I want to see the move come in, okay? So that would suggest a settling in somewhere around the 1547 to the 1533 area, which is where the EMA is. I want to see that happen. If that doesn't happen and we come back down, the market's going to have an ugly start, an ugly end to Q3, and a possible ugly start to October. Keep in mind the month of October tends to be one of the more volatile months. All right, and we've had some ugly history in the month of October if we go back decades in the SPX. So we've got to be careful here. If we look at this is just kind of a combined FANG index. You can see it's a lot uglier. We're nowhere near. It looks more like the Russell. We're nowhere near the all-time highs in the FANG index, which was made in the summer months here. And you can see we're well off of that. We're below the 50 and we're approaching the 200 EMA. So some of the FANG stocks are just not having a good time of it. All right. And of course, if we come over and take a look at volatility, just kind of see where vol is right now. We scooched right into the yellow here. This is the yellow zone. It kind of kicks off around a little bit over 15 and it runs up to 22. When we're in the yellow zone, certain option strategies perform better than when we're in the green zone, all right? And then we run into the rose, I guess, and then the deep red, and then we have what we call our black swan zone above 50, okay? We haven't been in it too often, but we have been in it. If we come back and just take a look at it, you can see back here, back in February of 2018, when we really crashed, the markets had that big, strong January run up, and then we had the big dislocation in the markets in February where one of XIV, I think, just stopped trading, right? It just went out. It was at 90, it closed one day at $95 a share, at $98 a share, and the next day it was out of business. Poof. But you can see here, looking back on this, the last time we were in the red zone outside of going back then was back here in December of 2018 when we had that big dislocation in the markets. Now, I attribute a lot of that to our own Boom Boom Powell. The market should not have sold off like that, but he set everything up to happen that way. And then he reversed himself in January, and then we've been on a run since. But you can see here how we're really down in this level down here. So vol, given all of the circumstance that we're in right now, given all of the mess and all of the confusion, vol is still relatively tame, okay? I would not be surprised to see vol move back up into the 20s again sometime in the next week or two, all right? But by the same token, as I said earlier, I also wouldn't be surprised to see vol drift lower. So we're in one of those kind of markets where we're waiting for a trigger. As I told our members, we're waiting for a trigger price to really move things around a little bit, or a trigger event. And there are a number of them out there, okay? And they are not tradable until after the trigger, although with our strategies, we're using a unique combination of stock and options or just options to trade these triggers so that we're not trying to pick a direction, which I think is one of the best ways to trade the financial markets right now. Is why pick a direction? Make money either way. Okay, so that's kind of what we're looking at right now in the volatility market. And then, of course, if I just close this down and take a look at the bond market. Bond market's finished up solid, a full one handle. So we had this sell-off right here. If you guys, I told our members back in this area here to pick up puts and TLT, okay? And a lot of our members did, and we made some great money here because we got a little bit overextended. Remember, TLT goes in the direction of bond market. But then we had this big sell-off, and now we're bouncing back up here. I'm not entirely convinced that this move higher is going to hold. But I do think we can skip up a little bit higher here before we roll back over again. So we'll take a look at this trade. We'll take a look at TLT and or TBT, but I think we're going to get some injection of volatility in the markets over the next couple of weeks. All right. And then, of course, if we look at currencies, well, the dollar finished strong on Friday. You can see here this regression channel. As I've told our members, every time we get towards the lower half of this regression channel, you want to be a buyer of the dollar and the seller of a euro, or go short euro dollar. UUP would be a proxy for the dollar that you could trade in the ETF market. Every time we get at the upper band here, you want to be going short the dollar or UUP until we come down towards the center here. So right in this area here, I was telling members again to short the dollar or UUP, and then we came all the way back down towards the center here. but lately the dollar's always maintained a bid. We haven't been below this center line really going back all the way since the summer months right here. Okay. So there's still strength in the dollar, especially after Super Mario came out, or as the German newspaper called him, Count Dracula. But Super Mario Draghi came out and basically said we're going to weaken, we're going to stimulate the European markets as long as we need to, which means, translated another way, we're going to weaken the euro. And if we look at the euro here, you're going to see what I mean. Here is the regression channel. It's just the opposite of the dollar. We've been moving lower and lower and lower. Anytime you get north of the blue line here on the regression channel, you want to be a heavy shorter of the euro. When you get down below the regression channel, you want to be a buyer. You can see the 2009 low at 109.28 to the dollar. And we're coming back down. I think we may test that again. It'll be real interesting to see where this thing plays itself out. And then, of course, in the month of October, it's going to be all about the Brexit. You can see this long, I mean, we entered this back in March of 2019, this long move lower. One thing I like about trading currencies, or the ETF equivalent of the currency, in this case, it's the British pound or FXB, is they tend to hold trends for a long period of time. And understand when you want to jump in, like on this one moving down here, you don't want to jump in right away. Wait for the timing. So wait for it to get at mid band or slightly above band, and then short the thing, or pick up puts in FXB, or just short the British, the pound futures. Um, because this is just one of these kind of trades you just can't help but take. Now notice over in this area here, once we broke to the upside, the dynamics have changed. We're going into the Brexit, and if Boris Bulldog Johnson can negotiate a softer Brexit, then that is just the pound is going to be a great place to be bullish. Okay, we're coming up to a key inflection point right up here around 126 to 1. And this would suggest maybe a little bit of weakening here, but the pound does want to move higher. Okay, once we break out of this regression channel, which also happened to be right around the 50 EMA as well, you can see there's no divergences on this MACD. This would be a sign that you want to look at a bullish action here. Okay, so any pullback right here, right now, is going to be worth taking a look at to buy. Okay, it's going to be choppy because we got the Brexit supposedly. Now, if it gets delayed to early next year, I think you'll see more bullish action in the pound, because then the currency traders would just make the assumption that the longer this gets delayed, the more it'll probably just go away and they'll never vote on it again. But Bulldog Johnson is really set in his ways. So let's see how this thing plays out. Meanwhile, the Japanese yen, which is where all the markets go in times of safety, all right, when there's fear in the markets, you can see the yen got a bit high here and has been coming down the entire month of September as the markets have been moving up. But now the yen is starting to move higher. So this would suggest the yen can move up just a little bit more, but I think it's going to roll back over to coincide with the move higher in the equity markets here in the U.S. But I think we still need a little bit more downside action in the equities and a little bit more upside action in the yen before we get that reversal. Okay. If we take a look at metals and gold, gold had a really strong Friday. It was up 18 points. You can see this move here. This is a buying opportunity for gold, guys. We've been bullish gold really since we broke this ascending triangle here on June 20th. All right, we broke it right around 1375. Had a buy signal in here on this. We moved right up to our value. We created a value area right here because this is where the bulls and the bears had a long fight. In fact, about a 60-day fight before the bulls won out, and we broke out of this 1443 range, and we immediately ran up to the 1500 area. Okay, this is our new established value area sitting right around 1512. That's where the bulls and the bears, the volume at price is the greatest. So we're sitting right in this value area here. So I do think being long gold, and we're also long silver as well. You can see silver here has just really, I think it's outperformed gold. In fact, I was telling our members back over here in the summer months, got to get long silver. Now, we had some members take silver futures. It's $5,000 a point. It's quite rich. Or another way to trade it for smaller accounts is SLV. You can see we were picking up SLV stock back here in the summer months when it was below 14. It was 1370, 1360, and now we're sitting all the way up here at 1680. We ran all the way up to 1834 up in this area here. I wanted to hold silver stock, so I was instructing members here to pick up puts right in this area here to kind of hedge some of our profits, and allows us to stay in the trade. But this looks just like gold. I think it's going to bottom out and move higher. So we've got to you want to have some of your portfolio in gold and silver. Now, if you want a little bit more action instead of gold, you can do the gold miners. Again, the same action on the charts, moving higher. We move below the 50, we kind of move back up above. I think the tendency is for gold miners to move back up again. It tends to be a little bit more volatile than gold stock, gold futures, but that's kind of where we're sitting. One other interesting thing I noticed is in copper. We had a move up in copper here in September as the markets were getting stronger. China was getting stronger. It looks like maybe the U.S. and China would do something. Copper started to move up, and then last week it gave up a bit of the run here. But if the China-U.S. trade deal starts to work out really well, copper futures is a great place to be. And if you can't do copper futures, Freeport-McMoRan, you can see the chart here is really solid. I mean, it moved from a low of 8.5 all the way up to 10.5 roughly. That's 2 points on an $8.5 stock. So that's percentage-wise, that's what, 20, 22, 23%. It's a nice move in a very short period of time. So playing some of these commodity stocks and or ETFs is a great way to add some robustness to your portfolio when some of the rest of the market is just seeing some rotational shift and it's a guessing man's game, right? And if we look at energy, oil, as you guys know, we had that really huge gap up right here in oil. Boom, we moved up, and now we're coming down. You can see the gap from that previous close was sitting around 55, and now we're at 58.09. I will say, I saw on CNBC one of the analysts there had or technicians had broken out, the gap ups and gap downs, and I think over the past decade there's been like over 100 gaps in oil, and only 2 times did it not fill the gap. Only 2. So the odds favor this thing filling the gap. Now at this level up here, I was suggesting to our members a safer way to play the downside action in oil, because once the Saudis came out and said we're going to be back online in a couple of weeks, which I doubt, but even the statement is going to end with an overflow of oil inventories. This past week we saw a build in our U.S. inventories. It tends to put downward pressure here. So I think in another 4 weeks, oil is going to be kind of around where it is now, although there will be a built-in risk premium because, now that the markets realize that the Saudi refineries are a little bit more susceptible to this stuff, you're going to see a $2 to $3 risk premium built into the price of oil. So rather than my target price of around 55 a barrel, which I've been talking about all year long, as you guys probably know, is probably going to be around $57 to $59 a barrel. As a risk premium built into this thing until we get a little bit more clarity on what's going to go on over there. So that's kind of where we're sitting in the oil market. And of course, nat gas, as I told our members, we were shorting nat gas, or we were going long nat gas down in this area here. We were doing bull put spreads or bull call spreads, and then the nat gas market or UNG. Up in this area here, I was suggesting credit spreads because it just got too extended because there's just a ton of supply in the nat gas market, all right, and it's not going to hold this very long. Now we are going into the winter season, so we get a natural bullish run in nat gas anyway. However, it just got too extended, so a little bit of a pullback here made sense. But we had a lot of members making some money on the nat gas play that we were putting out there. So these are just some of the things that we're taking a look at. We've got some things percolating in the ag market. and possibly in the soft market. But that is about it right now, where we're sitting. For our members, I will see you this Sunday evening. If you're not a member, I highly encourage you to come in, take advantage of some of our offers. We've got a lot of really good things going on, and our trades will, the success in the trades that we're putting out there, for you guys will cover the cost 4 or 5 times over real quick. For our group. So anyway, our user group is building really nicely. We've got a great international group of folks. We like to look at a macro view of the markets. We place option strategies based on that macro view, both short-term and longer-term, that have low risk parameters around them and high probability of success, which is kind of what we're looking for. We also have a special trading section for portfolio margin folks, because we have to treat portfolio margin slightly different. We've got some great portfolio margin trades that are floating around out there as well that work out nicely. All right, everybody, members, I will see you this Sunday evening. Everybody else, hope to see you on the inside. Come on in and join us. We're having fun. The water's warm and we're making money. Take care, folks. Ciao now.